SIS is a market leader in all three segments it operates in: security, facility management, and cash logistics services. Revenue from facility management recovered for the second consecutive quarter, and with that, margins are likely to recover going forward. Consolidated revenue grew 2% quarter-on-quarter, led by 4% growth each in India security and facility management business, while international business remained flat on a constant currency basis. EBITDA was lower QoQ on the back of non-recurring expense worth 8.2 crores. Profit before tax was lower sequentially thanks to lower other income, higher depreciation, partially negated by lower interest expense. Adjusted profit after tax was higher due to lower tax rate and higher profit from joint ventures. Net debt was lower by 4% QoQ as SIS paid some of it from higher cash flow generation. Contribution of the innovative tech-enabled solutions and new product lines was almost 5% of overall revenue. Despite fuel price increase, the business was able to maintain gross margins by focusing on management of on-ground routes, proactive cost control, and productivity improvement measures. SIS will acquire the remaining shareholding in the joint venture from Terminix. The JV Terminix International provides pest control and termite solutions in India. It mainly focuses on healthcare, hospitality, food processing, manufacturing, warehousing, pharma, and property management. In FY22, it had a revenue of 31 crores, gross margin of 40%, EBITDA margin of 11%, and ROE of 34%. The transfer of shareholding from Terminix to SIS was at a total consideration of $100,000. Meanwhile, SIS won its biggest contract from Mahanadi Coalfields, where they will deliver security solutions at 18 sites by deploying more than 3,000 security personnel in different categories. The contract is valued at approximately 226 crores per annum and has started from April 22 onward. While gross margins are likely to remain flat, operating margins of the company could remain under pressure due to front-loading of expenditure for this contract in the next couple of quarters. SIS also plans to invest 75 crores in SIS Ventures, a seed fund incubator for generating ideas in own addressable market and adjacent markets. On similar lines, it has invested in StackU, an AI-driven video analytics startup, by investing $1 million for 9.83% stake. And in case the startup requires additional funding, SIS will be open to acquire further stake in it. With the economy and commercial establishments opening up, demand for security services and facility management is likely to go up. Going forward, we expect India's security and facility management business to be the growth drivers, while international security business is likely to grow in mid-single digits. SIS management has guided to a 20% growth in revenue, operating cash flow to EBITDA conversion of 50%, and 20% return on capital employed. SIS plans to focus more on providing solutions than products and services. The future of the security business will shift towards technology rather than manned services, and this is where SIS plans to invest. With various business segments under its kitty, SIS also plans to cross-sell some of its services going forward, as some vendors prefer larger and financially more stable companies like SIS. With a likely increase in minimum wage from central and various state governments on the back of higher inflation, SIS is likely to be a prime beneficiary given that the service charges are billed to clients based on percentage to revenues. With increase in revenue, operating leverage is likely to kick in. SIS has completed acquiring majority of the remaining stake in its subsidiary companies, and therefore no payout will be required going forward. Of the 1,328 crores gross debt, nearly 45% pertain to long-term debts and is likely to be paid out from free cash flows, while remaining 55% is working capital debt, which is rolling in nature. Given the scope of higher growth rates in India businesses, majority of the services recognized under essential services, with scope of increasing market share, we recommend investors with a longer-term view to accumulate this stock and add on declines.